Well, as retailers gear up for the second half of the year, our next guest is laying out a roadmap for sector outperformance in 2024 with 7 catalysts she says would give the all-clear signal for sector recovery, although not all of them are positive catalysts. For more on all of this, Adrienne is joining us now, Barclays Consumer Discretionary Analyst. Adrienne, it's good to see you as always. When you look at these 7 catalysts, which to you is the most important?
The most important is we have 4 company-specific ones, and the most important was last year it was inventory. But the fact of the matter is everybody's cleaning up inventory. So now the most important thing is to see sort of that second derivative of demand. So any notion that over the next 6 to 9 month horizon, that demand becomes more forecastable. And with the Fed thematically pausing or slowing down their rate hikes, that certainly helps. With inflation coming down, that certainly helps. So the most important thing for us is looking at future demand and the ability to forecast that along with de-risked earnings and sales, right? So a lot of these companies, right, are coming out. We're in the early phase of our wholesalers. We'll go into retailers. If they can hold on to the guide and basically, do the back half and get to those earnings and op margins with freight and promo recovery and below the top line, and then have top line on tight inventory, that's what the call is about for 2024.
Which companies are best positioned to be kind of immediate beneficiaries in that instance then?
So the immediate beneficiaries, and mind you, right, sales are still coming down as we speak right now. So the Fed's 11 hikes in 17 months are doing their work right now. So as we sit here right now, sales don't look so great, and you're seeing people guide, particularly in wholesale, right? They're guiding slightly worse than expected. DTC, retail's as expected. But the names the beta play names, they're going to be your retailers, your frontline retailers, American Eagle, Urban Outfitters, Gap, Tapestry, Lululemon, right? It's going to be your frontline retailers who are exposed to you and I as the end consumer.
Since you mentioned Gap, I have to ask you about the new Gap CEO, Richard Dixon, and whether you think that he's going to be able to, rescue, maybe for lack of a better word, that brand.
So the brand being Gap, right? And then there's Old Navy. And Old Navy has a place, right? So I think when we think about GPS, because the namesake is Gap, I think Gap's a much more difficult animal to turn, right? We've got new leadership at Athleta from Alo Yoga. I think that's going to be, they lack innovation, but I think they're in a great sweet spot there. And then for Old Navy, I think it's just getting back to the fun and the innovation and some of the kind of kitschiness of Old Navy, which I think they've really lost their way there. So to the extent that he comes from Mattel and has sort of a background in consumerism and making things fun, you saw them kind of have a Gap X Barbie launch. They've got Love Shack Fancy. So they're starting to do some things that I think are very interesting and are much more consumer focused. So we're very hopeful. We upgraded them last week as well.
I'm also curious, in concert with this sector upgrade, you also, as always, are watching promos very carefully. And we have what struck me, you looked at a sort of a longer term chart of sales of promos from retailers going back like 10 years. And the trend has never been better. Like it never improves above a certain line, which really struck me here. But are retailers doing better at managing our expectations when it comes to promoing and their margins as a result?
So the source of promotions, as you know, I like to talk about this, is inventory. And it's inventory, more importantly, inventory growth relative to sales growth. We always like sales growth going faster than inventory. Inventory is very, very tight right now, but it's unfortunate that sales demand is so sluggish that they need to take this lower, units of inventory, this clean inventory, and they're trying to promote to drive traffic and conversion and to get you in the door. So, as we get through sort of the excesses of wholesale in the back half of the year, because normally retail and wholesale inventory are coincident when they're clean. This time, because we stuffed the channel, right? Globally stuffed the channel, the wholesalers are depleting that inventory in stock while the frontline guys are very clean. At the end of the year, everybody's going to be clean, heading into 2024 with a better forecastable demand outlook. And that's where we think it all comes together.
Stay with us, Adrienne, because on the topic of promos here, I just want to bring our viewers up to speed on Under Armour earnings. Under Armour earnings came out this morning here, and particularly on the revenue side, revenue was down 2% to $1.3 billion. We're watching shares right now. They're higher by about 0.7%. But as you were talking about promotions just a moment ago, Adrienne, their gross margin declined 60 basis points, and they pointed towards higher promotions and adverse effects from changes in foreign currency, partially offset by some supply chain benefits. All that considered here, I want to get your read in on Under Armour from this quarter.
So this quarter was largely as expected. The inventory is coming down. And again, they are, majority, right? So call it 58% or so wholesale. So what was interesting is their DTC business was actually up 5%. And that's kind of where they actually had promos. So they're kind of trying to clear through. And this is not Under Armour specific in their DTC. It's just a promotional environment, as I was mentioning before. One of the interesting things is they did reiterate the full year guide. And they are lowering North America, particularly in the wholesale. As we move through wholesale, right, the retailers are being ultra conservative. As we go into the back half of the year. But as we come into next year, right, it's very hard for retailers to buy down units again, right? Because if you buy down units, you get down sales. And so we think as we go into calendar, 2024, March quarter, June quarter, this is just kind of the cycle of wholesale, depleting that in stock, and then you'll start to see the kind of renewal or the replenishment. So Under Armour largely as expected. I think it's kind of, nothing to call out here, nothing alarming. Clearly, they did guide down their wholesale a little bit worse than expected, but the DTC should pick that up for them.
Adrienne, really invaluable to have your insight here, especially a few weeks before we start to get into these specialty apparel and retail earnings in earnest, and you're going to get busy. Adrienne Yee, Barclays Consumer Discretionary Analyst, thank you so much.
Thanks for having me.